Okay, folks, so we got to give a violent update on the market and plays, and then for the main entree this lovely evening, I need to discuss Cathie Wood and Ark Invest. With a lot of people starting to talk about shorting the fund, we need to go line by line over her biggest holdings and discuss the likelihood of each imploding in 2022. Of course, the growth sector has been under fire all year because of interest rate scares, but the actual hard interest rate increases are going to be happening next year, at least that's what's expected. Which of her holdings are the most at risk, and which ones are the most obvious dip buys if they do go down? But anyways, the only thing that I ask in return for all of this is that you hit that ravishing like button, and also don't forget to subscribe either. Also, this video is sponsored by our Black Friday sale on ZipTrader U. Coupon code BlackFriday100 will get you $100 off and allow you to lock in lifetime access to our lessons, our private chat, our daily morning briefings, as well as our price targets. Quick update on the market and plays. Market fairly mixed. You had inflation weighing on tech. The Dow was up a little bit. The S&P fairly flat. Certainly haven't seen much of a conviction market this week. It seems like people who like the fundamentals of companies, especially if they're of the small cap variety, just aren't seeing much reward. That said, we have seen a very strong short-term traders market this week. APVO was a little raunchy raccoon today. My thought process this morning was gains attention as company reports their treatment helped achieve a complete remission in an acute myeloid leukemia patient. Screw cancer, awesome to see this. This is why we have the pink cancer bracelet. But I saw the original run in the pre-market, and seeing the insane amount of volume flow and the low cap nature, I assumed a very, very high likelihood of a massive, bigger rally later on when the rest of the market found out about this. And likewise, my bull criteria was strong bull setup if holds retake support at 1185. It ended up selling off to 8. Teased some and then later hit my bull criteria and ran to 2208 at highs. The other one that I want to talk about is ISPC. So this one had an excellent catalyst yesterday morning. They were chosen by the US government and private researchers to supply needed human specimens for COVID research. My bull criteria was 804, and especially if it holds a breakout of resistance at 907. At that time, those were the numbers, and yesterday it just couldn't maintain strength long enough. I love the catalyst, I loved the bull criteria that we set, but the market didn't acknowledge it. It sold off almost right away. But then in the after hours, it finally hit that criteria at 804, and then you saw it rally to highs in the pre-market this morning to 21.6. Which is totally insane, and we're seeing these runners right now because that just happens to be the sentiment right now. But the point is that the cycle was short. By market open, it had already turned around and hit our bear setup criteria and tanked. I'm a big believer in having a bull and a bear criteria for catalyst plays because that way you have forced standards. A lot of people have no standards for themselves. They go out with the stinkiest stocks in the market, the stocks that don't shower, they're disgusting, they pick their nose. They go out and they're like, hey, let's go get married. Bad trades should never become investments just because you screwed up on the trade. But anyway, speaking of bag holding and not having high enough standards, Ark Invest. Okay, that's a joke. I just couldn't help myself. We love Ark Invest, but boy, are they stomach turners. Truth be told, there's no one that has been quite as polarizing as Cathie Wood and her funds. She and her ARK funds represent the face of last year's euphoric push into next-gen innovators, and this year's push to sell them because of the inflation scares and interest rate spikes. But Cathie Wood's objective was never to make short-term gains, but always to have a very long-term time horizon, and because many of her predictions are 5, 10, or even 15 years ahead, you're not going to be able to really judge Cathie Wood fairly until that time has lapsed. But in the short to medium run, we got to be honest, the performance of ARK and ARK Invest funds is going to be based a lot more on the Fed's trajectory for interest rate increases and overall tapering, and whether or not that induces risk on trading to benefit her fund that has a farther looking time horizon. My outlook is that 2022 isn't going to be a massive risk off year, but is rather going to be a selective risk on year, where the market rewards companies that are showing proof of concept currently or in upcoming quarters very soon, and perhaps sleeps a little bit more on the ones that have proof of concept farther down the line. So I want to go ahead and break down her holdings and give my thoughts on what is the most at risk next year and what is going to show the most proof of concept next year and probably perform quite well. I filled out the spreadsheet of her biggest holdings, which are Tesla, Teladoc, Coinbase, Unity, Roku, Zoom, Shopify, Spotify, Square, Twilio, UiPath, Exact Sciences Corp, Intella, Therapeutics, and Palantir. These are arranged by the level of capital that she has across all of her funds, so Tesla is the biggest holding. This one has been a killer, obviously, and built Ark over the last years. It's down about 10% from highs, and it's up 58% on the year. The industry is obviously electric vehicles, AI, insurance, and other Musk antics. Compounding growth rates of revenue for the next 5 years is estimated to be about 30%. Price to sales is 25.3. I used Finbox, by the way, for compounding growth rates and multiples just to keep some consistency amongst the comparisons. But odds are strong that Tesla actually exceeds these growth rates, especially 3-4 years out. But I would just argue that the risk with Tesla stock right now is that of the ones on the list, this one is the only one that's in an insane euphoric cycle. You could easily see a 30 to 40, even 50% dump of Tesla stock during a bear cycle. But at the same time, next year should be a very, very good year for Tesla, the company. Tesla has already seen a lot of their supply chain concerns ease. The company's numbers should start scaling up very, very well Q1, Q2, and Q3. But never forget, Tesla is the 6th most valuable company in the world right now by market cap, but it's not on the top 50 by revenue. And we're not talking profit, we're talking revenue. You have a lot of forward-looking capital in this. That is in this because of cheap interest rates and speculative trading environment. But I would also argue that come massive dips, it's more resilient than ever. And it's very likely that by 2030 or 2035, Tesla is a completely different company. A lot of people right now are bullish on Tesla because, oh, electric vehicles, and yeah, great electric vehicles. But I think 10, 20 years from now, the story isn't going to be the electric part. It's going to be the autonomous part. And it's not going to be personal vehicles. It's going to be you go on an app and you get a Model 3 come pick you up. It's going to be known as a massive, massive software company that runs all of the autonomous vehicles that transport us everywhere and save us from having to own cars ourselves. Next, we have Teladoc, 66% down from highs and a 45% year-to-date return. They are in the telehealth, telemedicine niche. This one I'm not that big of a fan of. I think it still has to adjust massively from its stay-at-home pump that it got because everybody was staying at home and telemedicine was going through the roof. That said, I think that the company growth numbers are going to be fine. It's just that they got really over-factored in because of COVID, and you have to get that effect wearing off and then get on a more natural trajectory. And when that happens, hey, if it's at a cheap enough price, I'd start thinking it's a good deal. It might be too cheap to ignore, but right now I don't like it. I think this is at a high risk of further implosion. Coinbase, down 38% from highs and negative 2.2% year-to-date return. Obviously, this IPO this year, so it wasn't a full year to date. My take is Coinbase is going to do extremely well long term, and it's going to do very, very well during quarters where crypto is hot. When you have new meme tokens, when you have anything that's running up huge, and all these retail traders are going and trading on Coinbase, well, all of a sudden you have a very, very, very propped up report. It's always a shocker to me that Wall Street analysts never appreciate this. Every single time crypto booms, Coinbase does very well, and the analysts are like, what? How is that possible? Bitcoin's going to the moon. You got all these people joining for the SHIB, and Coinbase is going to report record earnings? Who knew? I'd argue 2022 is going to be the year of continued crypto adoption and awareness. Coinbase is going to be one of the biggest beneficiaries of that. And so I'd say this one is one of the more solid plays on the list. Unity, down 17% from highs, 23% up year-to-date returned. This one has gotten a lot of attention because of what it can offer for metaverse development. They are a virtual asset, video game, and software development company. But a lot of their most extreme growth rates haven't really been factored into this company yet because investors don't know how to factor in the metaverse. You see, here's the thing. The metaverse is very, very, very early stage, but investment in the metaverse is going to come first. And massive, massive companies contracted with, say, Unity to build out metaverse technology is going to be something that allows Unity to make money ahead of everybody else before the metaverse actually goes super mainstream. Right now, it is pumped by overall metaverse hype. But once that goes away, I would still argue that this is going to be a beast in 2022. Roku, I'm not a huge fan of this company. The market isn't either, apparently. It's down 54% from highs, negative 27% on the year. This is, of course, a hardware and software video streaming company. They also have advertisement and whatnot. But for me, it's hard to understand why companies like, say, Amazon or Apple or any Samsung TV, LG TV, wouldn't just be able to come out with a better product themselves, and a lot of them are gaining on market share to Roku. Right now, Roku is a leader, but how long is that going to be maintained? I just think, hey, you know what? They'll probably do fine, but there's probably better growth stories out there, and this isn't one that I'd want to have conviction holding. Zoom down 66% from highs, negative 32% on the year. I actually like them. Sure, there's going to be a lot more video conferencing competitors coming out. There's already a lot, but they have a nice stronghold on the market, and they'll probably maintain it and grow it some. The only issue I have is still with that current valuation, because with the stay-at-home pump still wearing off, it has some more bleeding to do. But I think that you need about 2 or 3 quarters of a consistent growth before Wall Street's like, okay, hey, this is going to be growing organically on its own. COVID has nothing to do with its success. We are moving on to another level, a more mature exponential growth curve. Shopify down 12% from highs, plus 46% year-to-date return, e-commerce platform for online stores. This company is one of the biggest ones on the list that is showing proof of concept in the present day and in upcoming quarters, but the sales multiple shows how much the market has over-rewarded that. But I think that it's going to continue to be a relevant bull in 2022, but we can afford for this one to drop. I don't think it's going to implode, but if you see a massive dip on this one, I would start saying, hey, it's time to start making some arguments for dip buys. Spotify 62% down from highs, 19% down on the year. Music streaming, increasingly other media streaming. They kind of did have some of that stay-at-home pump going for them, but their forward growth rates are very reasonable and highly likely to hit in my view, and their multiples aren't crazy at all. Probably this one is a fairly good deal heading into 2022. Square Payments 40% down from highs, negative 4.45% on the year. I like this company, but fintech is in a very big bear cycle right now. The biggest leaders are selling off, the innovative companies are selling off, everybody's selling off in payments and overall fintech. There's a dousing of enthusiasm, but it's also true that people are like, okay, there's so many players, that means there's so much competition. So something like a Square is going to need to show a few quarters of, hey, we are leading the pack. We are winning. Don't buy every damn stock just because it's up. Buy the ones that have the damn wins. The market needs some time to understand which ones are the winners and to ignore the losers. And Square, in my view, is a big winner. Sales multiple is low, forward compounding growth rate is high. I think this one just needs some time and for this cycle to play out. Twilio, cloud communication, 70% down from highs, 16% down year to date. High growth rate, but a bit more forward looking than the other ones on this list. I'd argue that you're not going to see massive results in the upcoming years, and the price is probably going to be a sleeper until you either get a massive risk on cycle or you get those proof of concept years, 2023, 2024. So if I was going to say 2022 predictions, this one has a strong risk of implosion, if not a general wash for the year. UiPath, this is a company that I like, that I've been wanting to place a ZipU price target on for a while, but it's in the productivity and automation space, and it's very forward-looking. And I feel like we have enough early stagers, and you don't want to be overly concentrated in early stagers heading into a higher interest rate environment like 2022. You want to take strategic risk and balance it out across the board while focusing on growth rates, but not overly focusing on far out growth rates. UiPath, with most of its growth probably 5-10 years down the line, could easily see more discounts in a risk-off environment. So I have this on the sidelines. If it gets a good enough dip, I'd say, hey, it's a great opportunity to buy. And we'll probably make a price target if it does. Exact Sciences Corp down a chunk from highs, molecular diagnostics company, IntelliTherapeutics, biotech gene editing. I tend to be squeamish about buy and hodling biotech companies or anything related to science that I don't completely understand. With these, there's just too much uncertainty around what I don't know about the science and uncertainty around their pipeline for me to make a fair assessment, so I'll leave these to the scientists. Lastly, the tier of the Palin. Big data analytics. Finbox didn't have analyst estimates, so I used my own breakdown estimates from our Palantir video of 30% growth rate. I think that by mid to late 2022, you're going to see a lot of analysts realize they undervalued the compounding growth rate of the contracts that Palantir has right now, the expanding contract value, and future contracts that Palantir is likely to get. And by mid 2022 to late 2022, you're going to see a lot of people say, hey, wait, we screwed up. They're reporting much better numbers than we expected. We're going to go and buy. I'd also argue that of the stocks on this list, this is trading very cheap for what you're getting. You're within a lick to lows, and you have a very strong fundamental basis for this stock. So I think that Palantir is probably the least hyped on the list, but has some of the best risk to reward potential in 2022. But anyways, that caps off the video and her breakdown on holdings. My thought process with Cathie Wood is, at the end of the day, she's a very long-term investor. She doesn't care about short-term massive pushbacks because she's going for long-term gains. But if you're somebody who doesn't have that focus, or you're somebody who's trying to swing trade the plays, or you're somebody who wants a shorter time horizon, well, you got to be a little bit more sensitive to interest rate scares, you're going to be a little bit more sensitive to strategic risk on taking. And I think that if you look at companies that are showing proof of concept in 2022 and 2023, but also have high growth rates, you're getting a little bit of the best of both worlds. Anyways, folks, that caps off the video. If you have any questions, feel free to reach out to us below or join us on ZipTrader Circle. If you'd like to learn how to trade with our step-by-step lessons, our private chat, and of course our daily morning briefings, well, I'll go ahead and put a link to ZipTrader you below. Of course, we do have that $100 off Black Friday 100 coupon code discount. So if you are interested, this might be the time to do it. So go ahead and check us out below. We got a video that walks you through the course and what we offer. Anyways, that caps off the video. Have a good one. I'll see you in the next one.